Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, May the 22nd, 2025, recording this just after about 7 in the morning. Okay, so obviously the big news yesterday was the rise in yield. So let's just first of all have a quick look at that and see where we're at. If we look at the 30-year yield on the US, on the nominal yield, which is here, we can see that it's been pushing up towards this 5% level sort of a number of times. Actually, it's got there 3 times. But you can see that yesterday, on the basis the proximate cause, so the immediate catalyst was at 1 p.m. yesterday. There was a slightly soft US US auction for the 20-year, which tailed by about 1.2 basis points, which in itself is not enormous because the 20-year tenor is a tenor which a lot of institutions don't love. It's not as popular as, let's say, the 10-year or the 30-year. So that wasn't entirely unexpected, but it's come at a very sort of sensitive time because literally as we speak, the U.S. House Congress is debating this sort of, what does Trump call it, the one big beautiful bill, which essentially has, is projected to extend the tax cuts. There's going to be more deficit spending, and there's actually going to be not a huge amount of sort of cuts in terms of the spending. So the idea here is that the tax cuts are not going to be fully funded, and if anything, there's going to be. I've seen various sort of estimates, but the idea is that over the next period of Trump's presidency, there'll be sort of several billion dollars, several trillion dollars added to the deficit. So the point is, bottom line is that the U.S. deficit, if anything, is getting bigger and not smaller, as was promised, 2 or 3 months ago when Elon Musk came in with the DOGE, the Department of Government Efficiency, et cetera, et cetera. So the whole point here is that we've got the nominal yields here on the 30-year bond. As you can see, they breached that very important sort of level of 5%. And as we speak now, they seem to even overnight pushing up to about 5.12%. So the real question here is, is this going to create a problem for the equity market? And we did see the equities selling off yesterday. Just before we look at that, though, just to put this into context, it's not only in the US. And really the issue here is real yields, because if I've just got a couple of charts up here. So let's look at inflation swaps first of all. And you say, well, inflation's going up. But if you actually look here, this is the different tenures. So this is, what the market is pricing in for forward inflation. And if you look here at the 1 year, you can see that that is remaining quite elevated, about 3.3, 3.4%, and it's kind of it's stable but sort of quite elevated. But if we go down through the tenors here, and you look here at the 30-year, which is down the bottom in this sort of nice pink thing, you can see that is rising, but not enormously. If you look, let's say, over the last 6 weeks, let's say in the middle of April here, it was at 2.23, and we're now at about 2.43. So it has gone up a little bit, but really where the huge sort of increases is in the real yields. So if we actually look here at the real yields, actually, I'll just show you here the inflation. So let's look in the last week. This is the inflation curve. And you can see that inflation, has gone up, but not a huge amount in terms of inflation expectations. So the point here is that really what's gone up is the real yield. So we had the nominal yields going up, but what's actually sort of distressing the market, I think, is more the real yield. So the real yield is the yield, accounting for inflation. Now, as we've seen, inflation expectations have risen a little bit, but really it's more like the term premium and the risk. So let's look at what's going on here. So you can see here, this is the 10, and so the 5 is in the blue. You can see the 10 is in the white, and you can see that the orange is the 30-year. So what you can see here is that all of them have gone up, the real yields, but especially the 30-year here, it's really gone up quite a lot here. And it's now at about 2.8% on the 30. And if we look on the 10-year, which is the white one, about 2.23. So the problem here is that, anyone who's trying to do a project or do investment, even accounting for inflation, basically on the 30-year, so the longer term tenor, or the 20-year, maybe they're paying about 2.75 or 2.8% of real yield. So that's quite restrictive and quite burdensome for the economy. Now, if we actually look again, just have a look at, is that only in the US? One of the interesting things is that real yields everywhere, and I think I've got this here, bonds, rest of the world. Yeah, so if we just here have a look at the 30-year, just everywhere. So I've got here, for example, in the US, in the white, you can also see the UK, of course, is actually higher at 5.5%. You can see that the BTPs in Italy are a bit lower. And you can see over in Germany, they're quite a bit lower. But in general, what we are seeing is that the longer term yields are starting to go up quite a lot, especially here you've got the UK and the US, but even sort of in Germany and in Japan, as a lot of people have been speaking about, everything sort of climbing. So the point is there's more and more pressure on the real economy because as those yields go up, both nominally but also in real terms, that's going to put more and more pressure in terms of people or who want to sort of start investing in projects. So that's the situation here, and you can see that a little bit, especially if we just go back to the US. Just want to draw your attention here to kind of an interesting chart. So let's say, for example, we put on now, let's say the US dollar versus the JPY. And the US dollar's been selling off. So we saw that the US dollar yesterday sold off. And you can see here that over the last 5 or 6 days, you can see the dollar index is sold off, having a little bit of support here at the 61.8% fib retracement. You see this one here. But basically, it's been selling off. And you say, well, why is that? Because, sort of classically, when a yield, especially in the developed market, when the nominal yields go up, normally that will attract capital, which ordinarily would put upward pressure on the local currency. But as we can see, broadly speaking, the US dollar has sort of been selling off. Even on the back of higher real and nominal yields. But if we look at, let's say, the USD versus JPY, you can see selling off. I just want to overlay here something like the US 10-year nominal yield, which we'll put on here. Let's see, US yield. I think this is the one. And the point here is that what you can start to see is this divergence. You can see that ordinarily this is pretty well correlated. So you can see here going back in time. This is a daily chart. You can see that as the nominal yield rises, the US dollar strengthens in this case against the Japanese yen. But what we're starting to see here is a divergence. You can see it here as the nominal yield started going up, which is this kind of sort of purpley pink line here, a berry colored line. You can see the US dollar selling off. And then, then it came back. But again, what you can see here is that the US dollar is selling off as those nominal yields are going up. And that's a problem because what this is indicating here is that this is a lack of faith or trust about the US assets. And specifically, there's this idea coming into the market of fiscal irresponsibility. So a lack of discipline, a lack of responsibility that the US administration at the moment is not cutting deficits. What it is doing is cutting tax revenue, which is not funded and is actually spending more money. So we're getting this blowout in the US deficit. And a lot of market participants are starting to say, could we get some kind of Liz Truss moment where the bond vigilantes just push the nominal yields up to a point which really forces the US administration to sort of rein everything in. Now, what we just saw is that I think the budget overnight, well, I don't want to call it the budget, technically the reconciliation bill, I think was just actually passed a few minutes ago. So we're seeing here that the House passes revised Trump tax bill, sending it to Senate. So it has been sent to the Senate at 6:56, so about 10, 15 minutes ago. So the point is here, it looks as though this thing's going to pass before the Memorial Day holiday, which is on Monday in the US. Trump wants this thing passed. And basically, as this is passed with not too many amendments, still plenty of spending, unfunded or semi-unfunded tax cuts, that's going to put potentially a continuing upward pressure on the US yields, especially at the long end. And what that is causing is a pretty nasty bear steepening. So let's just look at a couple of the charts here and just see what's going on. So we also saw the VIX yesterday having a bit of a spike upwards, and we saw also the curve moving into a bit more of a sort of a backwardated state, so the front of the curve. And actually, let's just have a quick look at that. So as the VIX is going up, that's also putting more pressure on the equity market here. So I'm just going to quickly bring up the VIX curve. Just bear with me for a second. Go in here into volatility. Futures curve. Okay, so this should come up in a second here. Right, so what you can see here is that at the moment, we're now on the spot trading at about 20.5, which is more than it's been. You'll recall that over the last few days, it's gone down to 17, 18. So that's definitely going up. So the curve is still not in a backwardated state. But if we compare that to, let's say, a day ago, and you can see that suddenly, actually, it's the spot price has gone up. And if we compare it to a week ago, you can just see how much it's gone up. So this is where we are here in the white. and you can compare that to a week ago, you can see that the curve still hasn't flipped into backwardation, but it's definitely sort of going up. And you can see that a lot of the pressure here is coming in the next couple of future months, the forward months on the futures curve here. So it's interesting to see today what happens here. So VIX basically, which was at 18 or 17 and a half, now above 20. So let's just see what's happening. But that's not great for stocks if that's continued. We have had some stabilization overnight. Okay, so just continuing here, we see the VIX is up, and then we see the ES. I'll just grab some tea here. So on the back yesterday at about 1 p.m. of that spike in yields, we did see the equities here go up, or go down rather. Sorry, let me just pull in this. So at this point, the chart is still bullish, but so it's going to be quite critical today just to see what's going on, because we can look at, let's say, some Fibonacci retracements here. So if we look at the first fib, we're now getting on this shorter term one. We're now at the 38% fib, which is about 58.53. So this is the first thing which the bulls need to do. They need to step in here and buy, but certainly this is the key zone between this fib, let's say about 58.50, going down to about 57.50. So this zone here is very, very key. Because if we break down through there, the bulls are slowly losing control, and then we have all of these sort of moving averages. We've got the 50 and the 100 and the 200, very, very important levels here. So that should provide a little bit of support. There's also horizontal support here. So let's just see what happens here. And maybe the market will stabilize. But if the numbers are crunched today and this bill is passed and the market doesn't like what it's seeing in terms of too much spending, we could get a significant sort of continue to have a steepening of the curve. The nominal yields on the 10 and the 30 could go up to, let's say, 5. I think the most recent one was 5.17. Let's just have a look here on the 30-year. I think it was 517. So if we just have a look here, you can see that the recent one was about 517 or so. So we're getting up towards there. That could be like a sort of a barrier. But if it gets through there, this is not going to be good for the stock market. So let's continue to monitor that. Apart from anything else, we saw the stocks down. We saw a bear steepening. So we saw the front end of the curve coming down a little bit. So you can see here the 2-year yield, but not a huge real spike here. This is the 2-year yield. Compare that to, let's say, the 10, which was up a lot more, and then obviously the 30. So you see here like a pretty aggressive, longer end led bear steepening there, and that's going to be reflected if we look at the curve. So let's say something like the 2s, 30s. You can see here that curve steepening. Again, it could get a little bit of resistance at about 115, but the curve steepening here, and look even like the 10s, 30s. As I was saying the last couple of days, that's also kind of steepening as the long end bonds are taking all of the pain. Now, on the back of that, we did see that gold had a little bit of a pop yesterday, because gold does perform well when the market is concerned by fiscal profligacy and lack of discipline, potentially a debasement of the US dollar and inflation concerns. But we see here this Fibonacci level at about 33.30. That seems to have had just a little bit of a pause. We'll see what happens today, but that was under pressure. We're also seeing that the market is, if we look at something like copper, just finding it difficult here, as I say, to grind higher, just in this very sideways sort of trading range here. So the copper market is telling us that at least that it's concerned about global growth and is a little bit worried about just too much the tariffs and everything. And just getting back to the bonds, I just forgot to mention, it's interesting here that the 30-year yield, nominal yield, ripping higher, but if you look at the 2-year, still not going that much higher. And I wonder if that's indicating that the Fed, potentially could be looking at this. And if the equities sell off and the nominal and the real yields go up too much, could that actually ultimately cause a sort of a slowdown in the economy, which in turn would cause the Fed to have to come in and cut more than the 50 basis points, which are currently priced into the market. So I wonder there if this is why the market is just saying is not actually putting too much pressure upwards on the front end of the curve. Now, in terms of data, we do have a little bit coming out at this morning. Let's have a look. We have, as usual, on a Thursday, initial jobless claims. They've been very, very solid, to be honest, in the last sort of period. So if you look at that, that is expected at about 230,000. So creeping up a little bit, but still very, very solid. As always, keep an eye on the initial on the 4-week moving average, and also the continuing claims, to see if there is any weakness coming in the US labor market. And then possibly what might even be more important, we have the S&P Global, we have all the manufacturing PMIs. This is for the May period, preliminary, and we know there's been quite a big difference at the moment between the soft survey data, which has been very, very negative, whereas the hard data has been strong. So no surprises if this comes in a little bit weak, but let's look at the market reaction because maybe the market today is not in any mood to have either weak hard data, but even maybe even the soft data. So let's get a look at this. And as I say, this is preliminary reading for the May period. We have the manufacturing services and the overall composite. So definitely something to look out for. We also have existing home sales, which is maybe not as important. So let's keep a look eye at that. The other thing I just want to mention here, we still have the G7 meetings happening in Canada between all the finance ministers, all of the central bankers are there as well. And just interesting looking at USD JPY, the Japanese yen. As we saw in general, the US dollar was sold off yesterday. It's made a bit of a comeback in the last couple of hours or so. But what is interesting, you see that the US dollar is selling off quite a lot over the last 5 or 6 days against the US dollar. And just going to be curious to see if it goes down to test this very, very important 140 level. But maybe not, just because at 6 p.m. last night, there were some headlines that Treasury Secretary Besant spoke with the finance minister, Mr. Kato, out of Japan, and they agreed. It was kind of an interesting conversation because the press release or the headlines basically said that they'd spoken and they agreed to let markets set the price of the USD JPY. So that was actually a negative for the Japanese yen there. This idea that the US maybe in theory, at least in public, is not putting pressure on Japan to strengthen its currency. So the Japanese yen took a little bit of a hit there. If you look on a shorter term chart, let's say the 3-minute chart, you could see that took a hit about 6 p.m. last night. So that's something interesting. On the other hand, Finance Minister Kato did say to the Americans, to Besant, that they did not believe that tariffs was the correct way to go, and that negotiations without tariffs being imposed was the correct way. So it looks as though the Japanese are not particularly happy behind the scenes and even in public, and they're not at all sort of bowing down to the Americans and saying, oh, well, we'll do anything you want. They're basically saying, no, the imposition of tariffs is unacceptable and we're not liking it. So the point being here that, in my humble opinion, I do believe that the Japanese and American negotiations are going to drag on for quite a long time because the Japanese are not showing any early signs of caving to the Americans. Keep in mind as well is that there's a general election happening in Japan in a few months. And so it's going to be difficult in the context of an election campaign for any of the parties to make too many obvious concessions to the Americans. So I have a feeling that things are going to be sticky and difficult in terms of the negotiations with the Americans. And that could have repercussions on the FX here. Just in terms of other stuff, I just want to have a quick look here, guys, just to finish up with Bitcoin. A lot of people saying, is this a test for Bitcoin in this sort of moments of stress? Now, there was some positive news yesterday on regulation for Bitcoin. So that seems to be becoming more and more integrated in the sort of, let's call it the mainstream US financial system in terms of an asset class. But we can see that Bitcoin actually on the daily chart here did break out above the recent highs, above the trade range of 108,000 or so, and it's still going up. But it's interesting just for the technicians, the traditional technicians, that if we look at, let's say, a Fibonacci extended move here, pretty classical sort of technical analysis here, you can see that the measured move, the Fibonacci extension, certainly gives the possibility to Bitcoin to extend up into, where it stopped. I mean, who doesn't believe in technical analysis? Look at that beautiful 618% Fibonacci retracement level right there to the tick that extended upwards. But the point is that could extend even further into the 121.25 or even to 130,000 mark. So Bitcoin, doing its job. As a sort of a store of value, I guess you could say. So just also technically, it looks as though potentially it might want to retest this 108 level here, which often it likes to do, just retest the top of the range. But it would not surprise me if Bitcoin does push a little bit higher, especially if you're of the belief that the US dollar is becoming debased, inflation remains sticky, and it looks as though the Trump administration, despite the fact that they were chatting a lot early on, especially with Elon Musk and the Department of Government Efficiency, it does look as though their concerns, it's just too difficult politically to cut too much unless, of course, it's poor people. They're fine cutting poor people's benefits and having some tax benefits for the rich. But it does look as though ultimately the deficit will, if anything, not be cut and will actually sort of expand further, which potentially is a positive for gold and Bitcoin and whatnot. Okay, I'll leave it there, guys. As I say, we have the S&P PMIs at 10 a.m. and the initial jobless claims a bit earlier at about 8:30. But it's going to be interesting just to see finally if this bill is passed in the US. Today in the Senate, and secondly, what the actual numbers are, and if that starts to filter out into the market, that is going to be a higher deficit and not that many cuts. I've got a feeling that the 30-year bond yields and the 10-year bond yields nominally could keep on pushing the 10-year up towards 5% and the 30-year up towards 5.25%. And I do believe that could, if that's the case, that could put a little more pressure on the equities as well. Okay, I'll leave it there. Have a great day. We'll keep the conversation going. Thank you.